Welcome to the Fixer interview series. I've got Dave Baldwin here with me today. Dave and we're going to be talking about, should you be investing all your free cash, your profits back into your business, or what else should you be doing with them? First off, Dave, please introduce yourself. Tell us a little bit about what you do, and we'll jump right in.
Thanks, Justin. Yeah, so my name's Dave Baldwin. My company is Baldwin Systems, and I'm a consultant. My focus is really helping business owners overcome their growing pains, as I call it. And I like to, everything I do is focused around helping achieve greater clarity about the numbers and knowing what numbers to pay attention to and to measure to figure out if a business is healthy and where adjustments need to be made. So that's kind of my little overview in a nutshell.
So in the financial world, we have a term called familiarity bias. And this is where you get comfortable with something, whether you work for a company and you naturally say, oh, this company is great, and you end up buying too much stock in the company stock, or maybe it's real estate and you say, yep, understand real estate, and I'm going to keep investing in real estate, and the stock market stuff confuses me. And the reality is it's not necessarily more risky or safer. It's just I'm familiar with this, therefore I'm comfortable with this. How do you see that playing with a lot of small business owners? Do you see that same concept of they're familiar with it, and how do you see that dynamic for people you work?
I absolutely see that with small businesses. I mean, I think I'm of the school of thought that a lot of times you have to be willing to try things that are outside of your familiarity, because I think you're spot on with that. The tendency is to think, okay, I'm good at using this tool, so let's try. The old saying is, when your only tool is a hammer, every problem looks like a nail. And I see that type of mentality with a lot of small business owners, that it's the tendency is to think, let's go back to what's familiar and try that, without considering that maybe what I really need to do for the health of my business may be what's unfamiliar and might even make me uncomfortable because it's outside my zone of competence, or it goes against the way I've always been trained to do things. But that's especially when you have a situation like COVID-19 last year. You can see a lot of that kind of comes out. And I think one easy and obvious example is how we're doing a lot more virtually that we could have been doing for the last 20 years as a culture, but it didn't happen until necessity forces it to happen. So that's, I think, in a lot of ways relates back to what you said about familiarity bias. We're familiar with meeting in person and doing things face to face, but is it really necessary most of the time? Generally, it's not. So that's, but I could,
Okay.
So there's plenty of other examples, but I think that's a good one for, what's happening now.
So when we talk about small businesses and startups, you deal with a fair number of those. What mistakes are they making that they shouldn't be making? Is there a few things that jump out to you and say, hey, this is just a mistake with their finances they're making?
I think from the financial side of things, a lot of small business owners are not selfish enough, frankly. I think one of the things that can happen is there's almost a sense of pride that you'll hear from a small business owner that says, hey, I haven't taken a salary in 3 years, or, I pay myself last and I starve myself, and I work 14 hours a day and only get 3 hours of sleep a night and all that kind of stuff. And you have to ask yourself at some point, is that really healthy? And from focusing on the financial side of things, I think that the first thing that has to happen is the owner needs to get paid, period. I think if it's temporarily, I can understand if you need to subsidize a business or leave some money in, or maybe take a deferral on your earnings and say, okay, I'm going to suspend taking a payment just to leave some operating cash in the company to get over a short-term hurdle. That I can understand. But I think that, the idea that, that I see more commonly happening is thinking, well, profitability will come later down the road, and I'll just, when I get bigger and I add more employees, then I'll eventually get a paycheck. And from what I've seen, it really doesn't work that way. What happens is you get bigger and you have bigger problems, but you're still not getting paid. And so I think that as a company that it's in its early stages, if it's not making enough money for the owner to get paid, the owner needs to figure out why and fix that problem, and not subscribe to the idea that the problem will just fix itself down the road, because I have not seen any evidence that that actually happens.
Yeah, that makes sense. I've made those mistakes too. You pay yourself last, and there's no pay at the end of the day. Um, so the next concept is, all right, well, most of the time as a small business owner, and I'm sure you see it, the reason why we're paying ourselves last is hey, I got to build this business. I got to put everything out I've got into the business to grow it. Is that the right move? And maybe do you get to a point when you should or shouldn't be doing that? Or how do you see businesses? Should they be putting all their eggs into that business to grow it, and you stop at some point?
I always say I'm a fan of the expression begin with the end in mind, and thinking about exit strategies for a business. I think that the clearer a picture you have of what your exit strategy is, the easier it is to think about questions like, how much cash should I put into my business? One thing that can happen without an exit strategy is the tendency of what I think of as growth for growth's sake. And I didn't coin that term, but I can't remember where I heard it originally. But the idea with a small business, you can have where you're now growing revenues, but all of the additional revenue is just getting sunk into operating costs. Sometimes the operating costs actually grow faster than your revenue does. And that can easily happen if you're taking on too much payroll, or any number of different things that add to your overhead. So I think when you think about the exit strategy, and you say, okay, well, first of all, how much longer do I want to be working in this business? Do I have, how long is my working life? And how much more of my working life do I want to spend in this specific business? And so there's a lot of, I think, those types of questions that tend to fall by the wayside. Or other things that can happen is that a business owner may have all kinds of grand plans, but they're the plans that get written on a piece of paper and filed in a drawer, and then 5 years later they say, hey, whatever happened with these ideas that I thought I was going to do? So I think every business needs to be built with the mentality of being ready for sale, even if you're not going to sell it. So whether that's an acquisition by a larger company, or private sale to another person, or maybe if a business owner, if it's a multi-generational business, or if there's another employee that's being groomed for eventual business ownership, what does that look like? I think that really to really start evaluating what to do with future cash flows, it's almost impossible to have any meaningful conversation about that until that exit strategy is defined, and a time frame for the exit is defined, as far as at what point in what year do we need to start implementing the exit strategy, and start getting all those things into place.
Yeah. Okay. So that's, I guess, ties into that familiarity bias, as they really get comfortable in their business. And if you're just automatically saying, oh, I'm going to so-called grow to add more people or hire people, what you're saying is it really needs to be deliberate, and needs to be, all right, we need to do this because it truly makes the business better or more profitable, and not simply growing to grow. Is that a fair statement?
Yes.
Okay.
Well, the whole thing is, if you're increasing revenues and your operating costs are scaling with it, but profitability is not improving, as far as I'm concerned, you're not growing. Well, you're not growing in a way that's beneficial at all. You've basically just taken on a larger liability, and there's more problems that can happen. But what have you really accomplished if your bottom line hasn't grown?
Yeah. As we think about this, I kind of go back, let's call it a generation, and think about the movie stores where you went and you got your VHS tapes, and uh, not even a big chain, but just a mom and pops did great in, let's call it, the 80s and even into the 90s. And the concept of that business owner would say, hey, I'm profitable and I'm doing great. I need to expand to the retail space right next to me, or get another space, or buy the building I'm in. They may turn around and skip a decade and just keep on autopilot, and realize that all this extra effort and money that they put in may have just bought them a piece of real estate, and now their business isn't worth anything, because you can't compete with the Netflix or the Redbox or anything in today's reality. So I think that happens. I think you alluded to it with the pandemic, is the technology and the online has really shifted the way we do business quickly in the past year, but even over a decade or two, it's been shifting that direction. Do you have any other thoughts on how a business should say, I should stop investing in the business and I should start investing elsewhere?
Well, I think you make a really good point about external changes in the landscape, and the video store example is a perfect one of what possible. I think that if you think about doing a SWOT analysis periodically, which is strengths, weaknesses, opportunities, and threats, and think about what could potentially disrupt the way I make money now based on what's changing on the landscape. Technology is a big piece of that. But then also when you kind of go back to the familiarity bias, that actually can sometimes work in our favor, because just because a technology becomes available doesn't mean everybody's going to move to it overnight, because if it's not what they're familiar with, you're always going to have a certain portion of the population that's going to resist it and want to stay the way it is. But at the same time, just like you said with the video store, I think what happened there was you had a lot of exclusive content showing up on channels like Netflix. So there was just, people didn't just migrate for convenience, but they migrated because there was no other place to get their content. And I think that was a big part of the strategy for some of those digital streaming services. And then once they started getting people using them, then at some point people started to say, why are we going to the video store anymore? We just get everything this way. And we know how that story ends. So yeah, I think that's a really good point. And so I think the question it boils down to, from whether it's existing cash in a business or new cash flows going into a business, the question is, how solid is the foundation of this company as far as where this money is currently sitting? And do I need to think about diversifying a bit? And that really obviously depends on the specifics of that business. But I think the question I always look at is, if you look at the balance sheet of a company and say, what are the intangible assets? What intellectual property do you have? What do you have that's proprietary that could be scaled? That's really where the long-term value is in a business. And sadly, for a lot of small businesses, for that specific reason, there really isn't anything to buy or sell about the company, because what happens when you go in and you start a business and you don't put those measures in place, you've effectively just created a job. You haven't created a business. And so that you have to really think about, if you weren't personally there to run the company, what value would the company still have? And so if you can't answer that question, the reality is it's probably not worth investing in. So you've got to think about, how do I build something that somebody else would invest their money in? And then that's how I determine if I've got something that I'm willing to invest my money in.
Yeah. Well, so that reminds me of something that I've noticed over time is, as an individual, as a couple, if I'm talking about financial planning and building wealth, which is similar to a company becoming bigger, we have a very long-term focus where we want results a decade, 2 decades, 3 decades from now, and that retirement focus. And it's not an emphasis on, hey, I've got to put money in today, and it really matters what happens 2, 3 years from now. But in a business setting, I find it's much shorter. If I was in business running and saying, hey, I'm going to grow, and it doesn't really matter what I'm doing in 2 or 3 years, I just want to be really big in 30 years, it's way too long of a time horizon. For a business, I find that return on that investment's got to be a lot shorter, where you really say, yeah, if I'm going to put an extra X number of dollars in today, I need to be seeing results tomorrow or certainly next month. And if I'm doing some sort of expansion or hiring a strategic key employee, I need to see the results in a year or two. And it doesn't have that 30-year mentality. It's got to make sense today and in the very short term. And I think that keeps businesses agile, where they can adjust when the world changes. And if there's not something where you say, oh, I can put this money in today and I can see results that are worth it in a year or two, then you probably shouldn't be putting the money in at all. You should probably be putting it in the bank and putting it towards your own long-term future. Do you see that? And do you have any other thoughts on how, especially that you mentioned the solopreneur or the person who has a job. It's not truly a business, but they've got a business that's really a paycheck for them. How do
Yeah.
they discern that? And any final thoughts on how that business owner that's, let's call it a mom and pop business that says, hey, we want to grow it, but in reality, it's a good paycheck for them. It's a business that pays the bills. It's not necessarily something that's going to scale to tenfold.
Yeah, no, and I think that if you're in that, for somebody who's in that situation that wants to do something about it, there certainly are options. And I think you can, I mean, the first thing I would look at for the example you gave, let's say it's a service-based business, one or two people in the company, and it's in reality, it's just those one or two people doing all the work, and there's nothing that is investable about the company. You know, the first question I would ask is, what could we create for this company that would be a proprietary asset? And I think part of what you really have to examine for that type of business owner is how well does this specific business model really play to your competitive advantage in terms of what knowledge you have, what training you have, what direction you want to go. Like, is this something that could be built into a strong, like a permanent long-term vehicle that would have value as an asset outside of just providing you a paycheck? And if, you know, so I think a business owner really at that point, you have to decide, do you want to double down and go all in on this business and build something that's proprietary out of it? Or is it time to just get into something else? Obviously the answer to that is going to be, depends on who I'm talking to. But I think that if you want to build something that is proprietary, the first thing I would start with is delineating all of the processes that go into the delivery of your core product or service, essentially writing out your secret recipe book, essentially, and really taking the time to invest in thinking through, what is it that makes my customers keep coming back to me? What is it about my approach and the way I do things that makes them basically be willing to pay a premium price to work with me, even if they could get it cheaper somewhere else? Those are the kinds of questions that I would look at, and just kind of distilling it down to a step-by-step process. It's not necessarily fun or sexy or shiny, and it doesn't make headlines, but I think it's the real work that needs to be done if you want to build long-term value in a business versus just having a job.
Oh, that makes perfect sense. And I've got about a dozen different follow-up conversations I'd love to have with you off of this that just have my mind turning already.
Absolutely. Love to do that.
I think that's enough for today. I think we gave some people some great content. Dave Baldwin with Baldwin Systems. I'm Justin Struble with BSG Advisors. We're not brokers, we're fixers. Until next time.
Thanks, Justin.
Thank you for being here.
Absolutely.